Hello everyone, in this video we are going to cover the next chapter of ACCA FM syllabus, and that is accounts receivable and the second part of working capital management. Now this topic is highly important when it comes to exam from the examiner's perspective, or if you consider the probability of this topic being examined is quite high. So pay very close attention to the concept I am giving you in this lecture. For the ease of understanding, I've divided this chapter into two videos so that you may have a deeper understanding of the concepts. Now, if you come to the page number 40 of your lecture notes, we have got the start of the chapter from here. Accounts receivable, that's the name of the chapter. When we talk about accounts receivable, it's obvious that we know it is shown in the current asset portion of the financial position of any entity, and hence the part of working capital. Now let's read our bit description about accounts receivable. Offering credit, that is creating receivable by offering credit, has a cost, the value of interest charged on an overdraft to fund the period of credit, or the interest lost on the cash not received and deposited in the bank. An increase in profit from extra sales resulting from offering credit could offset this cost. Now, cost-wise speaking, the receivables should justify the overdraft rate. It means it has to bypass the gain that we are getting from the extending the credit, should overpass the opportunity cost that we have lost by depositing those funds during that time period in a bank, or perhaps if we fund our cash deficit through overdraft, it should justify or should pass, the gain should surpass the overdraft rate which bank charge on us. So that's what briefly what we will be doing in the receivables management. We will be comparing benefits and then cost. The benefit should always has to justify itself over the costs in order for the management to take or give extra credit or credit to the customers. Now, like with everything else, you need to have an accounts receivable policy to move forward. First step is formulation of credit control policy. That's the first step through which we will be managing the receivables, that is us financial managers. The first point is the administrative cost of debt collection. The first thing that in making the policy that you need to consider is the admin cost that comes with the debt collection. You have to make calls, you have to keep the follow-up, etc. Then we have got the procedure for controlling credits to individual customers and debt collections. The debt needs to be controlled by what will be the procedures through which we will be coordinating with the customers. Then we've got the amount of extra capital required to finance an extension of total credit. It's obvious that whenever we are giving in credit, that deficit, the amount that we are willing to get locked in the market in our customers, needs to be funded from somewhere else. So that this is also a consideration when making a credit control policy. The cost, fourth point is the cost of additional finance required for an increase in volume of account receivable. The same thing, the cost might be bank overdraft, and this cost can be ascertained where the rate which we can take over here is bank overdraft rate. That is what we use in a business to fund the short-term deficit. Then we got the fifth point, any savings or additional expenses in operating the credit policy. All credit policies according to the business have got different needs that needs to be kept in mind. So in this point we will be considering those. The effect of easing credit, i.e. high proportion of bad debts, might be encouraged. Whenever you give customers the ease of payment, that is extend the period for the, or give them that they will pay, they can pay anytime between a month. This area will always have an effect. This giving the credit strategy will always increase the risk of bad debts. Then we have got the 7 points, the ways in which credit policy can be implemented. But there are 2 ways through which we can implement this, whether to give or extend the credit period. We can give our customers the extended credit period, or we can reduce the credit period by giving them discounts, early settlement discount. If they pay us early, we can give them discounts. Now, there are certain elements of credit control policy. Here we are formally stepping into the concept of making a policy. That is, first step is assessing credit worthiness, then we got setting credit limits, then we got collection of overdue debt, and the monitoring the credit system. I've also drawn a flowchart somewhat for the ease of learning. We have got a credit policy. Now, credit policy, as I've just told you, should include all those factors, all those 7 points which I've just mentioned. After that, the next after the policy making, we have got to go the first step. The first step is assessing credit worthiness. On the criteria mentioned in the credit policy, we have to assess the customers, whether they will pay us, whether they will be able to pay us if we give them an extended credit. Then we have got credit limits. Different customers are assigned different credit limits according to the category of the customers. Financially strong customers, we can give extended credit to financially strong customers. Then we have collection of overdue debt. That's a third step. After setting the credit limit, we will be moving towards the collection of overdue debt. This can be achieved through a number of ways, via calls, emails, reminders, or credit agency. We can involve them too. And the last step is to keep monitoring the credit system so that it doesn't go out of date, or if there are any weaknesses or internal control deficiencies, then those needs to be addressed for this cycle to move smoothly. Coming back to the notes, we have got our first area, the first box which we just discussed is assessing the credit worthiness. Now, the risk and cost of customers defaulting will need to be balanced against the profitability of the business provided by the customer. As I've just told you in the beginning, the extra benefit of giving the credit should surpass the cost of giving those benefits. In only this way and in only then this decision of giving the credit will be justified. The first point is new customers should give 2 good references before being granted credit. One way of doing that is you can get good references. Now in the market, in the business, it's quite common for the other businesses that they give good references. If they have good interaction with other businesses, they can give references about the business to us, and on those references we can determine whether to give them the extended credit period or not. Then we got credit rating, which might be through credit rating agencies. Now credit rating agencies, especially the listed in the listed client scenario, you will always have the credit rating agencies rating their instruments and equity in the market. In this way, we assess how much confidence the market has on those companies. Then we've got a new customer credit limit should be fixed at a low level. Whatever the scenario, a new customer credit limit should be less at the beginning, and once it be a time tested customer, then we can extend the credit limit as well. For large value customers, a file should be maintained of any available financial information about the customer. Information is available from an analysis of company's reports and accounts and external cards. Large customers, it's quite obvious that they will be big companies, it's obvious for the big companies to publish their accounts on the website. We can keep a track whenever we talk about large customers. Best for the business to keep a separate file for that customer. So whatever we interacting, selling or buying or giving them credit or extending their credit period should be kept in check in line with that. And this could also include analysis of their financial statement, so that we may to actually monitor them, that they will be able to pay us the money. Press comments. Irrespective whether company is highly secured, press comments matter a lot when it comes to giving credit to customers. They will give the information about what a company is currently doing. The company should send a number of staff to visit the company concerned. In rare cases, if it's a substantial transaction, what we can do is send our employees to the customer's premises to assess how likely it is that we are to engage in business with that customer, and how likely is that they will prove beneficial for our business. We can do this also. After assessing creditworthiness, we are moving to our next box in the flowchart. As I have just told you, here it is. We just covered this area. Now we are moving towards the setting credit limit section. Now, setting credit limits. After assessing the credit rating of the new customer, the next step is to set the credit limit, which should be in line with the senior management credit policy. As I've just told you, we will be needing those policy which we considered at the beginning of this chapter to guide us throughout the way. In case of current customer's credit extension, requests should be carefully considered, and it will be necessary to assess the amount of invoices already billed and not yet paid, and outstanding date. What is the rate in which the customers pay us the money back, whether it's within the credit period allowed, or sometimes it goes out of the credit period allowed, and how soon they have paid us in circumstances, and how much delay they have made when we are doing business with them. Then we got the extra sales contribution and profit by allowing more credit. If we were to give them extra credit period, for example from 1 month to 2 months, what is the amount of business that we get from those customers? Then we got the extra cost of allowing more credit, such as an impact on bad debt and finance cost. After taking benefit into account, the next step is to take the cost into account. What are the costs associated with giving the extra credit? It's obvious. One of the costs is the finance cost of bank OD, overdraft, and the other costs will include admin costs and bad debt. The provision of bad debts will need to be increased simultaneously with the increase in credit period, as they go side by side, and increase in credit period means that the risk of bad debt also is increased simultaneously. Then we got the rate of return required from additional investments. The rate of return from additional investment in accounts receivable is obvious that not only we will be funding the deficit, but we will also need to fund the amount that has outgone. We need to fill up that lack from somewhere, so we need to consider the rate of return on that. Additional investment in working capital will be required. Then we have got the rate of return required from additional investment from in accounts receivable. We have already covered this point. Then we've got the format for this, extending the credit period. Now this format is quite flexible. It can include any sort of benefits given in the exam scenario. So it's not limited to this area. If in a question the examiner specifically mentions that these are the benefits that we will be getting, you should include those benefits. Do not restrict yourself according to the format. As I just told you, it's flexible. It can include multiple benefits. This format is constructed for the ease of understanding, for aligning our thought process that we need to compute the benefit and then deduct the cost to arrive at the net benefit or loss figure. It includes most of the obvious benefits and costs associated with extending the credit limit. Now, the first thing is the benefit arising from extending the credit. The first thing we need to consider is what's with the benefit that the business is receiving in terms of cash, obviously. Then we've got the cost arising from extending the credit limit, increase in finance cost. We will be computing the finance cost using the receivable days formula. Then there are more cash tied in working capital. If it requires additional investment, then that also becomes our cost. Then we have got increase in bad debt, the risk provision that needs to be increased. The risk provision of bad debt that needs to be increased will also be considered over here as a part of a cost. Then we have got increase in admin cost. It's obviously with increase in credit period, there will be increase in admin cost, and this also need to be incorporated in the format. And after deducting all the costs, we will arrive at the net benefit or loss figure. It is best understood if we could do that with an example. Let's do an example. Okay, we have got the first example over here of extending the credit period. Henrico is planning to extend credit period from 15 days to 30 days. They are doubling the credit period. The current sales is $600,000, and as a result of extending the credit sales, the sales increased by $300,000. The contribution to sales ratio is 50%. As a result of change in the policy, bad debt will obviously needs to be increased by $50,000 and admin costs will increase by $40,000. The current overdraft interest rate is 5%. Let's start using the format which we have just learned. Firstly, we need to consider the benefits, and the benefits over here is increase in contribution, $300,000 of extra sales, and 50% was the contribution, giving us a figure of $150,000. Then we need to consider cost, which as per the example we have got increase in bad debts, increase in admin cost, and increase in finance cost. Okay, the cost, the bad debt provision is 50,000. Then the increase in admin cost is 40,000, and finance cost is something we need to compute, so we will be doing a working over here. working one. Current receivables is 15 days. We do not know the figure of receivables, so we are putting an X over here. It's a receivables formula, that is receivables divided by credit sales multiplied by 365. That was the formula we learned in the ratios. So 365 it is, and when we compute all this, the missing figure of receivables become 24658. Now we need to compute the proposed receivables, which is 30 days. Now that's the extension, and again we need to compute the receivables. Obviously the cost of the credit sales have been increased by 300,000, so in the denominator we need to put the include the extra sales as well, and multiply by 365. We have got the of 73973. The difference of these two is 49315. I can get an extra space. Now the overdraft rate is, we now know from the example, is 5%. So applying that to 49315, 5%, this will give you 2466. That is our finance cost. Now putting the figure of 2466, again negative. Now the benefit, after deducting all the associated costs, relevant costs, we are arriving at a figure of 57534. The benefit is justified because it is a net increase in benefit. Because it is a net increase in benefit, that is net benefit. Otherwise we would have written a net loss over here. So because of the increase in benefit of 57534, the project, the extension of credit limit from 15 days to 30 days is justified in this example. Moving on to our notes, then we have got our next topic of collection of overdue debt. Now, due to the credit limit, decisions are taken, and credit limit says the next step is to send invoice promptly. Now, we are moving on to the next step of after setting the credit policy. In the flow chart, it's best understood if we can keep a track of it in the flow chart. We have learned the credit limit with an example. That was the second step. Now we are moving towards the third step, that is collection of overdue debt. Once the credit limits decisions are taken and credit limits are set, the next step is to send invoices promptly. The debt collection system should start the follow-up procedures immediately once the sale has been done, that is the goods have been dispatched. It's best to start the follow-up procedures immediately. Such follow-up procedures will include reminders. We first send them a thank you email, and after that we can start sending them reminders. Once that reminders limit is reached, that is set in the credit policy, we will start to do calls, start making calls to our customers as to when they will be available, or when it is likely that they will pay to us. In a rare circumstances, the third step, if that doesn't work, then the third step is personal visit. Our sales representative will go there, our receivable representative will go there and discuss the scenario with the customer. Then we got supplies withheld. Now 4, 5 and 6 is an extreme case scenario. We firstly cut off the supplies so that we don't incur further loss, because the risk of the customer is in this case is quite high. So we firstly withheld supplies. Then we consult an external credit or debt agency through which we are likely to recover the amount to to an extensive portion possible. And if that also doesn't work because of the size or power of the customer, is the final resort that the business has is to go to the court, to knock at the door of the court, to do they can bring their customers to justice in a legal case. That's the collection of overdue debt area. That's how we will be doing. Now, contrary to this, we need to have, what we can do is give an early payment discount to our customers. In this way, the bad debt risk starts to reduce. This is a great strategy, but again, like with everything else, the benefit of giving the extra discount needs to be justified with the cost associated with it. Moving on to that area, early payment discounts. Offering early payment discounts may make the collection process less difficult. The formula over here is 1 plus percentage discount over percentage amount net of discounts is to power number of periods less 1. And there is a format as well. Just like the last format, the benefits arising from giving the discount should exceed the costs arising from giving the discount. The obvious of all benefits and costs, I have mentioned it in the format. Again, it is flexible. You can include it, the benefits as given in the exams. Don't just follow the examiner when it comes to exam, because these topics of working capital are quite flexible, which means examiner can always introduce new things when it comes to cost and benefits. So do take those into account as well. It can simply put an environmental impact or reduction in environmental cost as well. So we can include that in our benefit or cost, whichever is justified in the on the logical ground. If it's giving the benefit to us, then there's a benefit for us, and if giving the benefit to the customer, or if it's it's not doing anything but to incur cost, then we can put it as a part of our cost. But it should be relevant. That's the main fundamental ground on working capital. It should be a relevant cost. The benefit arising from early payment discount, that is increase in contribution profit. We have just seen that in setting credit limit and in the example as well. Then we've got decrease in finance cost due to less cash tied in working capital. It's obvious that the customer will avail the discount. It's a likely scenario, so we will be reducing the finance which is required to fund the working capital. Then we've got cash tied in the working capital, that's point covered. Then we've got decrease in bad debt. Because of this, the bad debt risk starts to fall, and that's why the provision for it is reduced. Decrease in administrative cost. Customer, they do not need to keep on running after the customers for the collection. If the discount is giving, they will be running after the business so that they can get the benefit. So the admin cost is reduced in this way. Then we have got the cost arising from early sales payment discount, that is cost of the discount itself. What is the amount of revenue, the margin we are losing on giving the discount. Then we got decrease in contribution or profit, increase in again it's a part of the profit, that is decrease in contribution or profit. If our profit margin will be reduced, this is the scenario which needs to be considered. And the third thing is increase in finance cost due to more cash tied in working capital. Again, the finance cost is computed using the receivables formula. and that's how we will be getting to the net benefit and loss. So let's do that also with an example. We have got an early settlement discount. That the name of the example. Let's read out. Henrico is planning to give 1% discount to all its customers who pay within 15 days instead of 30 days. Normal credit period such as an action will result in $20,000 in bad debt and $30,000 in admin costs. That's a saving that we will be experiencing. Advise Henrico whether or not to take discount if overdraft rate is 5% and current sales is $300,000. Yeah, we will start from here. First is benefit. A benefit in saving in that is saving in bad debts. Then we have got saving in admin cost. That's the straight figures coming out from the example. So the 20,000 and 30,000 is the admin cost. Then we have got a finance cost, which we will be computing in working one. This benefit will have to justify itself with the cost element, and then we will be getting the net benefit figure. So we will be putting the working one over here. The receivables formula is straightforward. That is receivable days is equals to receivables divided by credit sales multiplied by 365. We have already learned this formula in the when we were computing the ratios. Now we need to compute that. Current receivables 30. We don't know the receivables figure. That's what we are after. Current is 30 days. 365 is the number of days in a year, or we are assuming there are 365 days in a year, and this will give us 24658. We need some space over here. Then we need to go towards the proposed receivable, that is 15 days. The benefit that is giving the discount, we if the customer is paying within 15 days, multiply by 365. Now the receivables becomes 12329. That is Now the receivables become 12329, that's 12,329. And that is our decrease in receivables. Now, in order to compute the finance cost, we need to consider the overdraft rate, which is 5%, and we will arrive at the finance cost of 616. So, getting back to the example, our finance cost is, that is the finance cost saving is 616. Now we need to compute the cost of giving the discount, that is the loss of revenue, which is cost of discount, 300,000 multiplied by 1%, which becomes $3,000, and the net benefit that we will receive is 47616. The benefit justified itself, and it's likely that it's obvious now that we will go with the giving the discount. Coming back to our notes, we have got an example over here. It's an exam style OT example. Let's do this example. I've already included it in over here. Let's solve that. The format which we will be using is same, which we have just learned. First, we need to look at the benefit and compare it with cost. Before we do that, let's see what the question has to say. Henrico has an annual credit sales of $20 million, an accounts receivable of $4 million. Working capital is financed by an overdraft at a 12% interest per year, and assume there are 365 days in a year. What is the annual financial effect if management reduces the collection period to 60 days by offering an early settlement discount of 1% that all customers will adopt? So the benefit in this case will be finance cost saving, which we will be computing by looking at the effect on working capitals, and the cost of this discount is simply the cost of discount, which in this case is 20 million multiplied by 1%, that is 200,000. Now let's compute that working one. We know the current receivables $4 million, and now we need to look at the after discount receivables. Now it becomes 60 days. The collection period has been reduced to 60 days. We are using the receivables formula. So receivables over credit sales. Assumption is all of the sales are on credit, so that will be 20 million, and there are 365 days in a year as per the question, which gives us the figure of 3287671. Computing these, and we have a difference of 1712329. Our overdraft rate is 12%. Applying that to the figure of difference, we have 85479 of that is our finance cost saving. 85479 reducing 200,000, and we have a net loss on discount, which becomes 114521. It's a negative. So that's the example, or that's the another example, the exam style OT example. You have to be able to solve these examples in the exam in the time condition. So that's it for this video.